how do you balance the valuation component of these businesses when you're looking to invest in them, especially today when like a lot of these great businesses, they seem to have very high multiples relative to their future growth prospects? Thank you so much.
Sure. So actually, what's interesting is Buffett says the best businesses in the world are businesses that earn very high returns on capital, and you can keep reinvesting a lot of capital into them. We sort of disagree a bit in that we think the best businesses in the world are ones that don't require any capital or minimal capital and literally can distribute out all their earnings and still compound at high rates and earn high returns. I'd focus less on multiples, right, and more on, remember, you own the value of anything is the present value of the future cash you can take out of it over its times. You know, a cheap stock can be at 35 times earnings, an expensive stock can be at 10 times, right? You know, what matters is what the growth trajectory is and what are the qualities of the earnings or cash flows generated by the business. If 100% of the cash flows need to be reinvested for the business to grow, or even just to kind of stay where it is, that's a very different story, and you pay a different multiple for that than a business that literally is a royalty. If you look at our portfolio, we own businesses, and I guess I won't name them because of the legal advice we got at the beginning. We love businesses that are royalties, royalty collecting companies, whether, you know, and those are, and ones we don't own. You know, think about Visa, right? I was asked, I spoke at a business school like in 1995. Someone said, what's the greatest business in the world you can come up with? And I said, you know, it's probably Visa or MasterCard, which is a royalty on people spending. The mistake I made was not buying Visa or MasterCard when it went public. So we make mistakes at Pershing Square. But so I'd focus a little, you know, multiple gives you an indication of your initial yield, right? If you're paying 30 times earnings, flip it over, you're buying at a 3% yield. The question is that coming to you in cash, or is it being reinvested at what kind of rate of return, and how can that grow over time? So it's, you know, it's a useful rubric to say, okay, what's the PE? But that doesn't tell you whether it's cheap or expensive. It's just one of the indicators of value.
More questions?
Bill, it's Stephen Clapham from Behind the Balance Sheet in London. Thank you for doing this and for giving us the opportunity to pick your brains. I've been an investor in UMG for many years, Vivendi, before it was floated. And I wrote when it was floated that UMG mathematically was worth more than Spotify. I was wondering if you could, without naming any stocks, give us a view of how investors are looking at the music industry today, where they're making mistakes, and how that might change going forward. Thank you.
Maybe I'll briefly comment, I'll turn it over to Ryan. So if you think about Spotify, it's in the business of distributing someone else's IP, right? It's a distribution channel, and there are multiple Spotifys. There's Apple Music, there's YouTube, there are other ways to get, it's a bit like the cable channel. It's not the content. You know, if you have unique content, I'd rather own the unique content than the distributor of the content. Because I think one is more of a commodity business. Now, there are things the Spotifys of the world can do to differentiate themselves from others. You know, and they're taking various steps to do that, creating premium, you know, content for their customers. You know, they've tried that with podcasts, et cetera. But, you know, which would you rather own, right? Would you rather own the Beatles, or would you rather own someone who distributes their records? Ryan?
Sure. No, I think one of the great things about the record label industry in general is that it's really a royalty on the growth of music consumption. Companies like Spotify and other competitors in the space have created a much easier transmission mechanism. You don't have to go buy a CD anymore in order to listen to one song on it. Now you have all the world's, you know, really, I think there's about 90% of all the music that's ever been created you can get on your iPhone and listen to it for a very low cost. And so what that means is it opens up the aperture of music listening to a lot more people. And if you're a royalty business, you're getting a clip of every single song that gets listened to. And most importantly, that form of entertainment is probably the cheapest form of high value entertainment of just about anything you can think of, because it really costs maybe 8 cents an hour in order to listen to it for the average user. That could be something people would pay a lot more money for over time. And these royalty businesses don't invest any capital to get all that future growth of all the music consumption around the world, and what we think is going to be increasingly valuable consumption that people will pay a lot more for. So it's really that business that you feel like you could own for a very long period of time, which is likely to grow at a very high rate. So those are some of the best businesses that we can identify.
And
That's
if you
very
think about
clear,
some of the structural changes that, are bad for office, work from home, people working from home are listening to more music than people working in the office. You know what I'm saying?
Your points are very well made, but the stock market doesn't seem to have recognized them. And that was really my question, because mathematically,
By the way, it's okay if your horizon is not short term. Actually, a business trading at a discount to intrinsic value can be worth ultimately more than one that always trades at its fair price, right? If you have a business that generates a ton of cash, it always trades at a discount to what it's really worth, versus a business that trades at fair value, that all same economic characteristics. You'd rather own the one trading at a discount because they've got another opportunity to use their cash to, in effect, retire their shares, right? That's an asset of a company trading at a discount that generates more cash than it needs, is the ability to buy out your partners at a discount to what the business is worth. And a lot of value can be created that way, and it's kind of another leg to the stool.